What is going on, guys? It's Lucatrades here again with another video. Today we're going to be quickly running through fair value gaps, how I mark them out, how I use them in my trading, and the difference between a respected fair value gap and an inversed fair value gap. So with that being said, let's get into it. First of all, what is a fair value gap? A fair value gap is essentially an imbalance in the market. It's an area where price moves aggressively in one direction, like here, and leaves a gap between the first and the third candle. So this, sorry, I actually marked that there. That also is another fair value gap, but this created two, but usually you go to the most recent one there. So that's fair value gap there. That's a fair value gap to the downside that I already have marked out. So basically, like this on TradingView, I mark out the fair value gap from the high end of the first candle to the low of the third in a bullish move, and it's the gap. So this doesn't, if there's a wick, it doesn't count. So for example, see how this wick goes up to here? The gap would be from there to there and not all the way from this candle to there. So it's not from where it closes, it's where the wick is. So think of it as an area the market skipped over because buyers or sellers were so aggressively buying or selling that price moved away way too quickly, and that's why there's these gaps here. More often than not, it comes back in and fills that gap. It either does two things. It either respects and move higher, or breaks and move lower, which is an inverse. So, or the other way in the other direction as well. So you can see in both these examples, they actually respected and moved higher and respected and moved lower. If this was to finish, if this 1 hour candle would have to finished outside this fair value gap, that's an inverse, and that's usually indication that we're going to be reversing. Same with the other side. If this candle here finished below, it's generally an indication that we are going to move lower. It's inversed it. Obviously, there's another gap here, so we'd need to inverse that as well. But I don't just trade off fair value gaps itself. It's something that I use as a confluence with a lot of other confluence as well, like a liquidity sweep, then moving down on the lower time frame, having a retracement into a fair value gap, breaking structure. There's a whole lot of other confluences. I don't just trade off fair value gaps, but they're a really good indicator and a really good tool to help you with understanding the bias of the market and which way we are heading, and giving you that extra confirmation before entering a trade. But yeah, basically, hopefully that gives you a better understanding on how I identify it, how I mark it and use gaps in my own trading. If you guys trade using fair value gaps, let me know if you do it the same way. If you found the video helpful, please subscribe, follow along as I document my journey towards becoming consistently profitable through futures trading. But again, thank you for watching. Leave a comment, let me know what you guys are thinking, and I will catch you in the next one. Peace.